What's up, everybody? Welcome to the Tribe of Millionaires podcast from GoBundance. Today, I talked to Brian Beers, a GoBundance member out of Philadelphia. He owns a bunch of Midas repair shops. He's an entrepreneur. He's an investor. He's just a smart guy overall financially. And we got to deep into the weeds on some things in a really, really interesting way financially. He breaks down a structure in different ways. Like he likens it to a football team and other analogies that are really, really impactful on how you build your financial structure for your life, essentially like you would a business. And even if you haven't built the business, if you're out there listening or watching and saying, hey, look, I'm a W-2 person. I have the dreams of building a business, but I can't relate because I haven't done that yet. He even gives you step one, step two in doing so. We went through a framework that he's put together that highlights where your money should be allocated from a standpoint of incoming from whatever source and where you distribute it so it's completely systematized. And one of those elements that we got deep on is something called infinite banking, essentially building your own bank through life insurance. Many of you may have heard of this concept. I know I had before, but I hadn't taken the time to really understand it. And part of that was the little bit I started to understand was a bit overwhelming for me, but he did a great job of breaking this concept down and convincing me it's probably time to go out and get myself an infinite banking policy. So check that out. Be sure to subscribe, like, comment on this video. Let us know what you think of all that Brian talked about, and just support for the channel, support for the podcast helps us get incredible guests. So I appreciate you all taking the time to be here with us today. Other than that, enjoy the very intelligent Brian Beers. Brian, welcome, brother. Good to see you.
Yeah. Thanks for having me, Jamie. And thanks for showing me your bare legs.
That's right. Well, it's the sock. I was showing you the sock. It wasn't the leg, but you checked out the legs is what you're saying.
It was hard not to. Yep.
Love it. All right. Well, let's get a little bit of backstory from you, Brian. I know you're out of Philly. I know you're into franchising between the lines. That's about, I don't know a lot more. So give me your backstory, where you're from, what you do, and all of that stuff.
Yeah, sure. So I'm 34 years old. I live in the suburbs of Philadelphia. My primary business is my brother and I, we operate a chain of Midas automotive repair franchises. It was something my dad and uncle had started in the 70s. They got into it because actually his cousin was in it in the 60s, like one of the first franchisees up in Boston. Anyhow, it was a good business. My dad had built it up to a number of locations. They had 6 or so at the time. And when I joined after college, I went to University of Miami down in Florida for a couple of years studying business and entrepreneurship. Anyway, I joined the business. I learned it from the scratch. I knew nothing about cars. I mean, I know things about cars now, but you don't want me changing your brakes anytime soon. But I learned the business, and my brother joined, and we just started growing. We started, acquiring other locations. A lot of them were older guys who wanted to get out. We bought a couple from them. We opened a couple from scratch. And so we grew from 6 locations to 8 to 9 to 10 to 11 to 13. And then we bought 7 more in New Jersey, and we've got 3 more under contract. So we will have 24 locations probably by the time this airs through Pennsylvania and New Jersey. We'll do about, I don't know, $25 to $30 million in sales. And, it's a pretty good business. So that's like my day job, right? We've built that. And then a couple other things. I invest in real estate. I've got a podcast I launched in April called Business with Beers, where I bring on other entrepreneurs. We talk about growing businesses, scaling, what opportunities there are, what challenges they have. And anyway, that's most of my story. I joined GoBundance in February of 2020. It was right before COVID. So it was a pretty perfect time to join with everything going down here and hearing all the stories and how everyone was adapting to it. So
no doubt. And I want to go there for a second. One question I want to ask, just from an industry-wide perspective, maybe this is my insurance claims roots, but on the body side, right? There's sort of like, you think about mechanics, people think like, Midas does it all, or like the body shop does it all. Mm-hmm. Like Midas is a mechanic shop. I think the mechanics of the vehicle, yep. Whereas a body shop fixes the body. But on the body side, I look at that industry as very much at risk given autonomous vehicle technology, sensors, all of the stuff right now over the next 20, 30 years. I remember hearing somebody say, we'll be laughing at the idea that cars used to hit each other, right? But at the same time, I think there's a lot of skill, maybe even pent up supply of body people that might want to get onto the mechanical side where you hire. Are you seeing that? Like, what is the future in auto? Because there are so many other technology pieces in vehicles nowadays.
Sure.
Like, what does it look like in your industry before we talk about GoBundance and all of that for the next 5, 10, 20 years? Is it a boom for the auto Mechanic industry?
So nobody knows, right? I think the concern is that, there's two ways to look at it. Number one is the fearful way, which is these cars are becoming so complicated, such like an iPhone on wheels, and
Yeah.
they're going to become so difficult to fix, right? Because it's going to be like nobody like breaks open their iPhone and fixes it for the most part, right? You like get a new one. Now a car's gonna be different because there's wear and tear. Even if it's this iPhone on wheels, you still have tires that wear down, you still have brakes that wear down, you still like hit things, whether it's a pothole or whatever. So, things are going to continue to break no matter what. I mean, there's wear and tear on them. I think that the like profile of the mechanic is going to become a lot more techy of a sense. It's going to be diving into the computers, communicating, figuring out what the sensors are. It's gonna be a lot more diagnosis of and programming related rather than just like finding a loose part and fixing it. So I think the dynamics of the repairs are going to change, and the type of people who are fixing them is the profile of that person is probably going to change. Now the idea of body guys switching over to automotive repair, I've never thought about that, but it could be a good source for us to find some new guys.
I'll tell you right now, being on that side in claims, every body shop, because I ran different departments. The last one before I left my job, I ran the appraisal division. So, you get in an accident, somebody goes out and looks at your car. That's what I did, right? So to your point, like I'm not going to fix anything, but it's amazing. I can walk by a car and tell you exactly how much damage is on still to this day. But the challenge for body shops was finding guys, because an insurance company might pay an affiliate market $55 an hour,
Yep.
and they have to pay their tech, a lot, per hour, and they,
Yep.
they all this the way the time is calculated without getting into too many specifics. But the biggest challenge was holding on to those folks. Like there wasn't a lot of incentive for body men to be body men, but over on the mechanic side, they're getting paid, $150, $200 an hour in the same dealership, right? So the dealer might have a $55 an hour body rate from the insurance company, but anything they could sublet over to the mechanic side was $110, $150, $200 an hour, and you had to pay it. So just a thought.
Yep.
So,
And for us, like as a business, they think there's going to be consolidation where the smaller shops are going to go kind of out and it's going to consolidate into the bigger brands,
sure.
which for us is kind of a good thing. And then obviously as the supply gets limited, and demand continues to rise, our prices can go up, and, we can charge more, just like you said, that 150 to 200 an hour, but then we also can use that money we're going to have to pay, higher quality mechanics and the wages that they're going to deserve to fix these cars that are going to become a lot more complicated. So
last question on the industry: are manufacturers, are they attempting to box out independents? Even a Midas is independent of the manufacturer, but what's that struggle, and where do you see that battle landing?
So there's this big thing, it's called right to repair, which goes through Congress, which basically says that the manufacturers kind of have to give the manuals to the independents. Because I mean, at the end of the day, the dealerships just can't fix all the cars on the road. There's just not enough dealerships, right, for the amount of cars. And so they need independents no matter what to do the volume. Otherwise, I mean, if you only could go to a dealership, your car could be there for 2 or 3 weeks or a month, right? If they were the only person that could repair it. So like for consumer reasons, that's why the right to repair exists. Now, from what I've understand is that, obviously the manufacturers want to limit the information. So they're trying to do what Apple and Android and Google, right? All these guys are limiting the technology. They're trying to take the same thing, says, hey, we have all this technology just like Apple does, and we don't want to give it to anybody. So there's definitely this fight there, but it's in the consumer's best interest for everybody to have it. And so I don't know if that answered your question, but that
does. No, it doesn't. I think you're spot on. I think a great point you made is that there's just not the capacity. It's like anything. It's why. This is what I know. Why are real estate investors incentivized from a tax perspective? Well, part of that reason is the government can't provide housing for everybody, right? So they incentivize private ownership through tax incentives. It's the same sort of thing. I don't think the dealerships can repair everything. So they, there's the incentive to use the independents. Go ahead. I'm sorry.
And competition, right? If they were the only ones, they could set whatever price they want. They could sell you this super cheap car, but then charge you like $500 an hour. And if it was your only option, I mean, it reduces competition. And there are a number of independent companies that produce like the scan tools that communicate with cars that back into it. So they'll take the scan tool that the dealership has that you can buy. They'll basically break this thing open and try to rebuild it from like scratch to circumvent. They don't get the manual; they just create the manual basically. So there's plenty of guys out there working to support like the non-manufacturers and non-dealer independent shops, franchises, whatever, to give consumers the best options.
Entrepreneurship at its finest. And speaking
Yeah.
of, you were an entrepreneur. You've been an entrepreneur, obviously. You kind of it's kind of a pedigree of yours. But then you mentioned you kind of came to GoBundance. Talk to me about, like what's the difference? So why, like you're an entrepreneur, you join GoBundance. What's life before? What's life after? Give me some
Yeah.
differences.
So I think the first thing I always think of is, you have all these assumptions of how you think like the world works, like how money works, how deals work, what I don't know, how banks lend, just how people think, just going in, whatever preconceived notions you have. And then, you join GoBundance, I join GoBundance, and then you realize that that's not how the world works for some other people, right? They get financing that's creative and that nobody else gets. They structure deals in a way that, you never would have thought of. And they just think differently. And I think that's the big thing is like we have all these assumptions that we think we know the world works. And then you get in this room, you start learning all these things. That's not how the way it works. Like you can get, there's way better ways to manage your money. There's way better ways to invest it. You can get these financing deals that, don't really even make, like, you don't even get it, but they're making money at it. And then you start to learn this stuff and then it starts to click. I think that's like, for me, I don't know about for you, but that's like the biggest one is just realizing when you're in a room or you hear all these guys that just doing amazing things that like, it's really different, in these inner circles than what you think it is.
Yeah. Well, like Ryan Bowden, I just had on. I don't know if
Yeah.
you,
Yeah. He's one of the guys I'm thinking of. Yep.
right. Right. Yeah. I mean, it just like, again, I wouldn't think of, he's just saying pretty much that, like, how would I put it? Anybody goes through the checklist. We all know the checklist, but like his mind saw in between two checkbox items, like, well, wait a minute. If you aren't going to do this, I can do that instead. And it's even though I hate the guy, it's the Bill Belichick mindset, right? Like, he finds that one thing in the rule book that he can exploit, not, but still follow the rules, right? That's kind of
Yep.
what Ryan learned how to do. And even like, as we sit here and we're recording this tomorrow, I was telling you, and people that listen know this, I'm heading to the Dominican for a few weeks, right? Like that idea, like, wait, I can go away for weeks at a time and still exist and live and have a life. And like I can design a life that way. Like even that, not even financially, but just in any way, you're right. Think differently and expose me in my mind, at least, to so many different things. So yeah, give me more on that. What else do you?
Yeah, sure. So I think, a lot of it comes down to private investments, right?
Sure.
So like, I think for people who aren't in our world, they're kind of in this box, and in the box, they want to invest their money. What are their options? Well, they can go like up, and they're stocks, right? So they can invest in stocks in any flavor they want, whether it's an index fund, a mutual fund, a like EFT, individual stocks, right? But at a certain point, you kind of reach a ceiling of you want to invest in public equities, diversify, but it's all in the same class.
Yeah.
Right. A single tweet from Elon Musk can like totally erode a day, or, the government changes, from Trump to Biden, or, Biden to whoever. And like the entire market can fluctuate. Like your entire net worth can fluctuate based on like a single person tweeting, or, the government change. All these things are like way out of your control. Right. So you got that. You want to like lower your risk from these things. You can invest. You go to the right, you hit bonds, right? So you can invest in bonds. You can make like, what's it, 1% right now, like 1.5%, 2%. Yeah. And if you want flavor and diversify, you can have government bonds, corporate bonds, public utility bonds, but still a bond, right?
Yeah,
you can go like, if you want store value, maybe you go to the left and you can bang into, gold, silver, some sort of like EFT that's related, but it stores value, but doesn't really grow. And then maybe at the bottom, there's real estate. So people want exposure to real estate. Ideally they, the box wants them to stay within. They invest in an EF or a REIT,
yep,
or they're buying some single family homes, maybe some multifamily. But like that at a certain point, a lot of people don't even go that route. But so they're in this box, and like the government wants them to stay in that box. They want all your 401k dollars like contained in stocks and bonds. They all want your savings account right in banks that they're going to use that money to then lend out at 10 times the amount. And they want everybody to live in it. And I think, what I've learned through being GoBundance is that you got to break this box, and that outside of this box, there's this other like box that lives, and it's got, up top, instead of just taking public equities, you can go above and you have private equity. So you can invest directly in companies. So like, both you and I are investing in the Green Coffee Company, yep. Right? So we're taking a limited partnership in a company. So that company does its thing and it goes public one day, we're all going to get a great return on it. We can go to the right. Instead of going bonds, we can get into lending, right? You can get into the hard money lending. You can get private lending. You can have secure collateralized real estate, but get much better returns, doing private direct loans. If you want to get into real estate, instead of, maybe single family homes, you can invest in syndications. You can get into multifamily. You can expose your money that way. On store of value, if you want to go beyond gold and silver, you get into crypto, right? There's lots of ways there of store of value. So there's this whole world that exists for accredited investors that is outside of this box. And then once you kind of break that wall, I mean, the options become unlimited. And so I don't know, for me, it's exposure to those things has been, one of the biggest takeaways I've had.
What's your strategy now then? So if it's like, hey, yeah, this the tried and true stock market methodology doesn't work for me. What are some things that you're most interested in? You mentioned about the private equity, like, investing in green coffee and so on. So are you going that route? Consumer product, private equity? Is it real estate? Are you dabbling in all of it? Are you like, is there a way you're distributing your net worth across, like you said, stores of values like crypto? Okay. Give me a little bit of what have you executed? Yeah. Since learning this.
Yeah. So one of the things I'm working on is to systematize, kind of this theory. Because once you start getting into this world, and really you manage your own money like it's a business, where most people manage their money very passively, like they stick it on an auto invest into Vanguard, and it's this thing that they just like don't touch. But then they also view it as like, I don't know, like a battery that they're charging up. It gets to a certain amount, and then they quote retire, right? And then they just deplete the battery now for the rest of their lives. Like it just goes up and then it goes down.
Great analogy. Yeah.
And I think that is what most people are taught. Like the government, like Wall Street they've taught us that this is what you're supposed to do, and that you're an idiot when it comes to managing your own money. So don't manage your own money. Let us do it. Charge up this battery and then we'll deplete it. And so, what I've learned and come to realize is that, for entrepreneurs, so for people who have built a business and, they're have a net worth over $1 million. Because a lot of these deals, you got to be a accredited investor, which is either 300,000 of income if you're, married, or, $1 million in net worth, that, we have all these options available to us. And then you can manage your money like it's a business. So, as a business owner, what do you look for when you're running your business, right? You focus on, you have a vision, you have a game plan, like where are we going? What's my strategy to get there? You have diversification, right? Like in Midas, we don't sell like one product, right? We do brakes, we do tires, we fix suspension, we sell radiators, even with tires, right? We sell different brands, right? So we diversify. And I think when it comes to building our wealth, it's the same thing. So it's really what you understand. I say like diversify, but don't dilute. Like if we diversified in Midas to doing auto body repair because we could, like, and we diversified into, all right, well, every customer comes through the door also needs insurance, then we try and start selling them like State Farm insurance or something. We would dilute our core focus, which is, repairing the vehicles. And I think for the wealth side, it's similar, where if I'm going to invest, I want to analyze these deals, but I only want to invest in things that I understand. So like I'm in a self-storage deal with Sergio and Mark, right? I understand the concept of self-storage. People need to store their crap somewhere. They pay them every month. Like they're going to they're going to raise rents and build more units. That's how we make money, right? I have invested in multifamily through a couple value add deals where the rents are 600. We're going to renovate them and get them to 700 or 800. Like pretty simple concept. I understand it. Right. I have the coffee company, people drink coffee.
Colombian
his model
coffee,
is right. Colombian coffee, right? We're buying up all these farms and we're going to be the biggest producer. And then we're going to market a brand, go direct to consumers. Right. Like I get that. And so I've got another one. It's a office. It's a ground up office construction for a really good guy and a good company. And so for me, like, those are all things I understand. Like if on the wealth side, dilution would be if I think I got into all these things that I didn't really understand, but people are talking about them. Like if it was, I don't know, crypto, I don't know, you can go down these rabbit holes with crypto and NFTs and all this staking and maybe stuff that I don't really understand. But if I put my money there just because I thought it was cool, that's when I think you start to make mistakes, versus you diversify up to the point that you understand the model. You can explain it to somebody else. Like you get how they make money. And so that's part of it. Cash flow, like as an owner of a business, cash flow is critical, right? Like it doesn't matter what your sales are if you don't have any cash flow. And I think the same goes through your wealth as you build, like, you focus on cash flow, what's the distributions back, and then you can start to compound those returns. And then finally it's team. You got to build a good team. And just like in our business, we got to have a good COO, a good finance guy. We need good managers. We need good salespeople. We need good mechanics. I think when you look at your wealth like it's like a business, you got to build a team around you. And so what does that look like? I mean, I associate it with like an offensive line. So you're Buffalo Bills fan, and I know. So like
Right.
you're the quarterback, right? So you are making all the decisions. You're calling the plays. In front of you is the center, right? So the center would be your spouse. So they're the one who's they're handing you the ball. And if you're not on the same page on terms of what your strategy is and where you're going, right, that ball flies right over your head. And so that's that. Your business partner would be like the running back. So he'd be the guy you're handing the ball off to, like going through the line, right side by side. Guarding you, you've got like you need a solid CPA, right? And you need a solid attorney. Those are your two guards. You need the other linemen would be like, you got a coach, you got a mentor, you got other people who are on your team who are helping making sure you're on the right track. Then you've got, agents. You have like a real estate agent, maybe a life insurance agent, whatever it is. And then on the wide receivers are then your sponsors. So these are the guys as part of the GP who are, you have the big plays that are going to get us like a 7x return on our money. You're going to get us a 20% IRR, whatever it is. They're the guys who are good for those big, like long-term plays. So I think a lot of that is, when people start this journey, like their team is built based on convenience. Like their attorney that they work with is just like somebody they know. Their CPA might be like their dad's CPA who they kind of like inherited. But it's you got to ask the question, like, is this person a deal maker or a deal breaker? Like, are they bringing me deals? Are they helping me like with my goals and my vision, or are they kind of holding me back? And you got to go through multiple people. I mean, I'm now on my third or fourth of a couple of these people, because we have a certain objective, I don't know, from a tax standpoint, and the CPA is telling us, well, no, we don't want to do that, we don't want to do this, and like we're like arguing with them because for us, we want to take all of our depreciation now. We want to pay as minimal taxes now because we want to continue to take all that money and compound growth. Like that's my current MO. We're young, like interest rates are low, right? We want to, but his philosophy, he's older and saying, well, taxes are low right now. You should pay your taxes now. And then like, he was more on this conservative, like maintain model. And mine's more this, like, I want to compound growth. I don't really care. I'll find depreciation next year and to use. Right. And so we didn't align, I think, on the vision and the direction. And then it became a deal breaker because it was everything we wanted to do. He kept arguing with me versus like, I want somebody who's going to, tell me that I see what you want to do. Here are some ideas. Here's an intro to another client that we use that's doing something similar, right? The deal maker one should be introducing you and should be helping you achieve your goals, not, what it feels like holding you back sometimes.
There's a lot of gold in there, man. That deal maker, deal breaker thing. It's funny. Like my business partner on the multifamily side, I just got exposed to his CPA, and I really like the guy's vibe. Like he knows what he's doing. He's a CPA, all that stuff. But to your point, he's looking for ways to, as opposed to ways not to. And within, I want to be clear, like legally, of course,
Yeah,
but like he's looking for, again, in that
we want
box.
the edge. We want the edge of the line is where we want to
right
live.
up to
like,
it. Right, exactly.
Yep. And he wants
My
to live
CPA,
like way over here, and it's like
right. My CPA is knowledgeable, but a bit less inclined to be aggressive. And again, I don't want anybody to do anything illegal on my behalf. That's not what I'm asking for or want from a CPA. But it's funny you talk about that. I love the distinction of deal maker versus deal breaker, because in my mind, it's like there is a little bit of that thought, like, well, she knows what she's doing. She's a good CPA. I mean, she does a great job. She's decent cost. She understands the ins and outs of real estate specific. That's what she specializes in. But there's just something, and that's it. It's the deal maker versus deal breaker part of it. I always feel like the deal is broken. Like, I don't feel like it's like, oh yeah, cool. Like, take my momentum, know where I'm trying to go. And then, find the way for me, clear the path. Like, guard, pull, go around to the other side and open up the hole for me, as opposed to just blocking the guy in front of you when I'm trying to go there. Right. Like, call that audible. I love the football reference. Yeah. Go ahead.
And even for me, like we're getting into the hard money lending business, where one of our passive income streams is to lend out to other real estate investors looking for a bridge loan, for a flip, whatever it is. And so, I'm working very closely, with my attorneys and with my accountants to make sure we structure all this right. We get the right, all the documents, all the stuff, and just ask them, hey, do you have any other clients that do this? And they end up introducing me to guys that they do the exact same thing, that run, $30 million funds. Yeah. So they make the intro, and then me, total newbie, can talk to this guy through this mutual connection. And he, ask him any question I want, and he's telling me all the answers of, how they're looking at deals, how they're underwriting deals, their margins. Like, once again, that's a deal maker. That's somebody who's, and I had to ask for it. Like, sometimes they don't just like tell you, but you ask, hey, do you have any other clients? He says, yeah, I think we do. And let me see if I'm allowed to introduce you, and you make the connection. So I think that's the key is, and if they're not helping you, like just cut the cord and go find someone else, ask for a referral. I mean, there's plenty of people who are more than willing to share, their team members and help their clients grow. So
Sense. Talk a little bit about. I love what you how you broke it down: vision, strategy, diversity, diversification, cash flow, team, kind of the business of money management, right? And this is relevant for me as a newer entrepreneur, right? I was a W-2 guy for a long time, and hey, drop it in the 401k, right? I got this, and then stock options, cool, but I still have to vest those later, and
Yep.
like I was in that matrix, and I guess in some ways my mind might still be. Um, but talk to the person who's listening that's not in GoBundance, that like vibes with the idea of GoBundance, but maybe has that job and they're trying to figure out like, all right, I love this idea of being an entrepreneur. I want to get there. How do I start? What's the first thing I need to do if I'm going to be going down this path of, taking more control of my money, treating it
Sure.
like a business
Yep.
versus set it and forget it?
Well, I think one of them, which maybe actually I didn't mention, which is community, right? Which is actually joining a group like Abundance and being around people. Just like, when you run your business, you network with other people in the same business, you learn from each other, you grow together, you have challenges, you're able to bounce them. I think community is a huge part of this, that, GoBundance like takes the cake on the community. So I think that's number one. If they're not in it and they want to get there, I think the Ascend, the Emerge, all these programs we got, I think now are pretty amazing for throwing down the rope and helping people get to where they want to be if they're the right person, right? They got the right mindset, they're taking the right actions, they're motivated, they're smart. And anyway, so community. Then it's like this system, and you say, all right, I want to invest. I'm going to sell all my stocks, right? And I'm going to control my own money. I think it comes down to breaking it into separate compartments. I'm currently calling it the envelope investor. There's this old like budgeting system where, you get your paycheck and you like have these different envelopes and you cash it and you're putting money in each envelope for your mortgage or your gas or your insurance or, whatever it is. And then you only spend the money that's within the envelope. This is how you can maintain a budget. Now, obviously most of the people that are going to be, potential credit investors are probably beyond like that method for managing their money. But from an investment standpoint, we can take a similar philosophy and strategy where so money comes in. I've got 4 accounts that I look at. Number one is we have an operating account. All right, this is an operating account for your life, and so this would be, for me, it's an account that like my credit cards get paid out of, my mortgage, just my general living expenses. And my goal is to limit the money into that account that's pretty much equal to what I want my expenses to be. So let's say it's 10 grand a month or whatever it is, like 10 grand a month comes in, 10 grand a month goes out. Like I live off this cycle. So that's like your one account. Then you have another account that would be your savings or your emergency fund, right? 6 to 12 months of living expenses or whatever number someone's comfortable with. Because your goal ultimately would be put to be cash poor and just put every single dollar you have available to invest, so it can start earning, you start getting compound interest. But I think for a lot of people to do that is, these investments we're going to be talking about are sometimes, a 1 year, 3 year, 5 year lockup of their money. Like it's not liquid. The benefit and the security blanket of the stocks is at any point you could if it's not a 401k or whatever, you could liquefy it, you could get it, you can have it. But like ultimately, it's nice to have that sense of security, but like, why would you need it? Like what would happen in this event that you would need? Ultimately you need time, right? You need 6 to 12 months to say, if my business like totally had this big hiccup, I had no money coming in, how long do I need to I feel that I can get back on my feet before I have to touch anything else? And so anyway, the second account is you just have the separate savings account, this emergency account with whatever number of months that make you feel comfortable. And maybe so if it's $10,000 a month, maybe you have 120 grand in there. Maybe it's more. I don't know. It's up to that person. I think that can vary. Then you've got your, and this is a whole nother topic, but an infinite banking policy. So it's this permanent whole life policy that acts like a high yield savings account with some added benefits. And this is, like I said, this is a whole nother topic on its own, but the general concept is you commit to saving a certain amount of money, you're putting it into this policy. But unlike traditional whole life policies, you're able to access the cash within the policy through a line of credit. So you put money into this policy every single year, but then immediately it's available through a line of credit and that you can then use to make an investment. So anyway, there's a whole nother component to that, but that's one of them. And then the final one is you have an investment account. So let's say you're making whatever, 30 grand a month, right? You got 10 grand a month coming in, that goes in your operating account. That thing just like kind of circulates. You got your money in your emergency account, and then the rest of the money goes into this investment account. So say you got whatever, $20,000 a month in there. And the goal is then you separate that, right? So you got these four different envelopes: operating, your emergency, your infinite bank, and then the investment. And then as you start to build that investment account, once it gets up to a number, you pick a number that you want, maybe it's 50 grand, right? Then you've got that money that you, in your mind, I can go deploy. So then you go find a syndication, you invest, maybe it's me and we're doing a hard money loan. Maybe you invest into, one of these private equity deals, whatever it is. And then your goal is that all the money that you make from that investment gets deposited back into that investment account. And so this thing over time, every single month, you get your business distributions going in, and then you start to have multiple streams of income, right? I'm in 5 different syndications every month. If each one of those cash flows accordingly, I'm going to have 5 additional deposits right into this investment account. And then this thing just continues to grow. And every time you get to a number that is, you can deploy it, whether, it's 25, 50, 100. It's really up to the person and what the strategy is, but you continue to deploy. But I think it helps your mind to be able to separate into separate accounts versus if you only had one fund, like you had one Bank of America checking account, and within that one account, you had to keep track of, what's my credit card month going in and out? How much do I want in savings? How much do I need to save to fund this like life insurance policy? And then how much can I spend to, deploy in this investment? Like, it's like a lot of decision making would have to go on when you see this bank balance versus if it's separate, you kind of know based on what the numbers are, what I can do, what actions I can take, or what can I not do? Said, hey, I got to hold off a couple months. I'm getting low. I got to like build this thing back up. So anyway, that's kind of the strategy I'm working on developing, and eventually going to hopefully be launching a course and kind of this like system in a box. Like you said, for people who are looking like this all sounds great, but like, what's the strategy? What's the tactical approach? How do I actually do this? My goal was then to create it so they can just like follow this plan. They can interchange things as they see fit, but it's at least a system that they can follow that will help them break the box out of the stocks and the bonds and the things that are totally out of their control.
Love it. That's tremendous value add to have something like a repeatable system, because your point about decision fatigue is real, right? Like when you have to think too much, things fall apart. It's little things. I lay my clothes out in the morning or at night for the morning, so I don't have to think about the next morning. I know I wake up, put on my clothes, go to the gym or whatever, right? So that's what you're essentially doing, is systematizing your income to go into different buckets so that you don't have to think about it. You don't have to, like you said, have one account and like, okay, where's it going? I got to remember this is coming out here, this is coming out there. Can you talk for a minute about infinite banking? So let's say, and we were talking a little bit before we started recording, like I'm familiar with the concept, but I honestly haven't looked at it. Maybe it's just lack of time. Maybe it's intimidation around the concept of it or whatever. But all right, let's go base level here. An infinite banking concept essentially is that you can invest, you can put money into an insurance policy essentially that you can then, like you said, loan out, take out a line of credit and invest with that money. So as you were saying, you make a return on the investment, and the value of the policy increases over time, right? So you get that double bang. But what does it take to say, like, is it $500 a month? Is it 100 grand? I got it. Like, what is it that you have to do to set one up? And then give me an example of how you are maybe, or how you might use this concept.
Yeah. So I think, first of all, the setup of it, you got to work with somebody who like is an expert on it. If you call your normal insurance guy, unless he specializes in this, like, don't do it. You got to find a guy that this is like all they do, or one of the things they do. Cause there's a special way that it's designed that gives you the benefits that we're going to talk about. So the first one's find a guy that's like reputable and they know what they're doing. The amount of money that you put into it is totally up to you. It really depends on someone's income level. And then I guess ultimately what they want to do with it, because what you're doing is you're really committing to think of it as a savings account, right? So let's say it's $25,000 a year. I think that would be probably the minimum I would do, because the goal of this is this builds up, and then you got to put it to use. And a lot of syndication deals, they have like a $50,000 minimum, right? So even at 25,000, it would take you potentially 2 or 3 years to have enough money in there to deploy it. Now there's other ways you could probably earn, but like to do anything substantial with it, you need to have, enough money to do something with it. So Tony, you pick a number. So let's say it's 25,000. That is the maximum that you can contribute. Now there is like, you don't have to do all that every year. If you said, I want to do less one year, you could. There's a minimum you have to do to maintain the policy. But so the benefit of it is there's a couple different ways. One is you're building cash value. So the thing is growing. You'll have a guaranteed return from the insurance company. It might be 3 or 4%, right? That at minimum, you're 100% guaranteed by the policy that this thing is going to grow. But if you go with a company like I use Penn Mutual. It's a mutual company instead of like a publicly owned company. So a mutual means it's owned by the stockholders, by the policy holders. And so then they provide a dividend. So based on the underwriting profit of the insurance company. So Penn Mutual makes a profit based on their underwriting. They then distribute that profit to the members. So currently, for mine, I think it's earning like 5.75% interest on it. So I have a guarantee 4, and it's effectively 5.75. So and it's also tax free. Like as your policy builds, like you don't pay any taxes on the growth within the policy.
Versus if you took initial investment is taxed already, is that why? Like you're putting
you're putting post tax dollars in, and then all the dividends, all the guaranteed growth, the dividends, everything grows tax free within it. Versus if you took that same amount of money and put it into something that earned 5.75%, in a tax, like you're going to be paying taxes on that too.
Right.
So
you're not getting 5.75%, right?
Yep, that's diminishing it. So you have this guarantee growth, but then you also have this opportunity to earn more. Now the dividend, the higher growth, 5.75 is not, it's not guaranteed. It really could vary, but the certain companies like Penn Mutual have like this track record of, whatever X number of years or decades of paying a dividend. So that's part of it. That's where you pick the right broker who can help like place you in the right company. So you've got that. So every year you're putting money in, it's growing at a guaranteed rate. You also have a death benefit. So that $25,000 initial deposit might get you like, I'm just going to make up some numbers here, but maybe like a $3 million death benefit the first year. And so then, and as it builds, that death benefit goes up. And so by the time you are like 80, let's say, that death benefit could be, let's say, $10 million. Like it really depends on the policy. You'd have to write it out, but that thing builds. So then when you ultimately you die, that death benefit can go to your kids. And if it goes the right way, it can all be tax free.
Wait, let me just make sure I'm clear on a couple of things. My brain was thinking as you were talking, so I might've missed it and I apologize, but so I open an infinite banking policy for $50,000, right?
Yep.
The death benefit when I open it, I know you're projecting, but it's not the value. It's not the 50,000. It's
nope.
like a term policy, like whatever you select, or is there?
It's the way they write these things. It's a couple $1 million. It'll probably be $2 or $3 million on the if you died that first year, and then every single year as you put more money, because every single year you're putting 25 into this thing. The cash value is growing, but your death benefit's also growing. You can think of it like a house, right? So the 50,000 is like your down payment on the house.
Yeah.
The house has a value, right? But you have debt. Sure. You have to have debt on the house. And then every year the value of the house is going up, which is the death benefit, and your equity in the house is growing too. That would be, your cash value. So ultimately when you die, like that house is now worth $10 million and you have no debt on it. Like the debt is you being alive. So when you die, your debt goes away, and then your family would then get the entire the death benefit of the policy.
Got it. Okay. And then the other question is, so 5.75% is the interest you're gaining on the value of the policy as you put money into it, right? So let's say you $200,000, you open up an account, you open up an infinite banking policy, and then you immediately take out a line of credit and deploy all $200,000 into 4 different deals for $50K each. Am I getting paid an interest rate on the $200,000 that's sort of like, and I'm doing this with air quotes, no longer in the account that's been deployed out to invest? Or is it only once that money returns, whatever's coming back into the account, that you accrue interest on?
Yeah. So great question. This is what I think makes it special is there. Well, once again, all depends on the bank. This is I'm speaking from experience with Mutual, but
neither of us are experts on this.
Two separate things. So you have a policy that you're putting money into, it has cash value, and it's got a death benefit, right? This is like, it's an asset that you have. And then you have another account, a separate bucket that is a line of credit. And that line of credit is using the policy as collateral. So you're going to put up this policy. A bank is going to give you, if you find the right bank, like the one I'm working with, 100, I can access 100% of the cash value at Prime right now. So if I've got $100,000 of cash value, I can access I can take $100,000 from this line of credit at, as of today, I think it's 3.25% interest, right? And the policy, honestly, they don't even know that they're being used as collateral. Like, I'm signing off with the bank, staking my policy as collateral, but no money is actually leaving the policy. It's just up there. Like, you're putting up a loan. It's your collateral, because from the bank's perspective, if you were going to die, they know what your cash value is. It's $100,000. They're going to have access to it. Plus you have this death benefit, and the bank's not going to let you borrow more than what the cash value is. So the bank has like near zero risk on this, because if you default, you don't pay the bank back, they're just going to wait until you die, and then they're going to claim on the policy. And so you have this policy, you've got this line of credit, you're pulling the cash out of it, right, at 3.25% or whatever it is, 3.5%. Interest rates are going to rise, and then
get 8% with it.
Your goal, is then go and deploy this cash. Now, a couple different philosophies. One philosophy you have is, you could invest it in something that has like maybe a monthly recurring revenue. So if it's me, I'm going to go do hard money loans. I'm going to make 10%, whatever it is, and then so now my margin, I'm making 6.5% on that money. I'm earning 10%. It's costing me 3.5%. I've got the 6.5% margin. Or, but it's going to cash flow every month. And every month I'm going to have a deposit in, I'm going to have an interest charge out, and that checking account's going to build. I could take that money and I could compound it back into the investment, right? Or I could use it to pay down the line of credit, or I could go spend it. Like, the goal's up to you. Or you could take that money and you could invest in a syndication, right? That could pay you maybe a 15%, but like it doesn't always flow like that, right? You could have no money for 2 or 3 years, and then they give you all your money back. But once again, as long as you got some money to then support whatever your interest payments are, at the end of the day, you're going to be positive. So anyway, yeah, that's how it works. There's kind of these three components. You've got the policy, which is this asset. You have this line of credit that you're using as collateral, and then you have this investment that is ultimately supporting it. And so when you run the numbers on these things, if you were to forget the policy, you said, I'm just going to invest in this thing that earns me 10%, and I'm going to put $25,000 a year in it, and I'm going to compound on my returns. At the end of the day, you look at what your account balance is going to be, and you're going to pay taxes on all that gains, versus you do it within this policy. I mean, I guess you're still going to have taxes on the gain and investment, but your policy is going to be gaining. You're going to have the death benefit, plus this other side. So
I've only heard great things about this. John White's a guy I think that is pretty expert on this. That's in GoBundance. I think this is his space, if I'm not mistaken.
Yeah, he does it as well. Yep.
Right. So there's some guys that have some like you said, broker this sort of thing, find the right people. But it is fascinating. And now you're getting my juices flowing on, like, as we go into 20.
So the next level, not to like totally like
no, please,
but like, people talk about like and I don't actually know why it's called infinite banking, but the idea is like you become your own bank. And at a certain level, what happens is, like, so I have a policy for myself, my wife, my 2 daughters, who are like, 5 and 7 months old, at obviously smaller amounts. And, you can have all the beneficiary of all these policies go back into a trust is the idea. And so ultimately, I die, my wife dies, like, there's gonna be a couple $1 million that is going to go back into this trust, which then acts like its own bank. So then if my kids, want to go buy a business, or they want to go invest or get down payment for a house or whatever, instead of going to a traditional bank, we're going to have this trust, and they can then borrow. There's going to be a new policy on them. So let's say that the trust can pay for. So let's say that the trust takes out, I don't know, whatever, a $50,000 life insurance policy on one of my daughters when she's 18 years old. That will start to accumulate cash value, right? And then she can borrow from her own policy that the trust pays the premiums to, and then go do the investment and then pay it back. And if she didn't pay it back, like, ultimately she's going to die one day, right? And then the funds kind of recoup. And so this is how, like, if you Google the stuff on like how the Rockefellers have transferred their wealth over the years. Yeah. This is the exact way they did it. It was through life insurance policies and trusts. And, because if you don't do this, all that money gets diluted, right, to 2 or 3 kids, and then their kids get diluted to 2 or 3 kids. And then every time that happens, there's taxes, and, people are making maybe poor decisions because, maybe they don't know what to do with it. And so anyhow, it's a ton to talk about, but the idea is like, you have control. There's all these advantages. It's just, it's pretty complicated. And, I guess one of my goals is to help people like simplify this thing down into this like system in a box that they could like follow this strategy step by step and not just be like this theory and this thing we're talking about, but like,
I love
what is it?
I love the idea of systematizing finances. And again, I think the unique value proposition you're talking about is it's not just a simple, sort of T. Harv Eker model of like just put some money here, some money there, like in different accounts for different spending reasons. You've got this infinite banking concept that you're like, I think you did a great job of explaining it. Like, makes sense to me now. As part of sort
Is
of the
one of the
system.
things. Yep.
Yeah.
And you wouldn't put all your money into it, but it's like, hey, I know I'm going to invest at least $50,000 a year into something, right? So you might as well stick it through, like you wash it through this policy first and it comes out and then you continue to invest it. It's just, you run it through this additional channel that then has guaranteed growth. It's also protected from creditors. Life insurance policies are generally pretty protected. And so, plus you have this death benefit, which is ultimately going to help your family in the long run. You set all this thing up right. So
what's the downside? What's the negative? Like if you were to say, hey, the one thing is there.
So yeah, there's a couple things. I think one is you got to have a long-term outlook because, the first couple of years, they're paying commissions to the agents. They're booking the costs for the death benefits and stuff. So like on a $50,000 a year policy, so you give them $50,000, your cash value that first year might be like 35,000. So you have like a $15,000 cost that first year. And then the next year you put another 50, you might have 100 into this thing. And maybe you've got $75,000 in cost, right? But by year, usually about 5 or so, that's when 5, 6 is when it starts to kind of break even, where the money you put in is equal to the money that is in the cash value they have access to. So I think a lot of people, when they look at the ledgers, that's where they get stuck in, is that, there's a huge cost in the first couple of years to do it. But by the time you get to year 10, year, 15, year 20, the IRR in this thing, the average annual return gets into that 4.5% to 5% range. That's the, between the two numbers we talked about. Yeah. Plus you have the death benefit. Plus you can hopefully pull this money out and to earn at a higher number in another space. And then in parallel, you have these two different accounts that are both building. So that'd be one. The other, you just have to commit to the number, right? Whether it's 25 or 50 or 100. You commit every single year. I'm going to put this money towards it. And if you said, hey, 1 year, I'm like, I don't know, it's tight, I can't do it. There is a minimum, but you're going to then start to lose some of that compounding effect. So it would be pick the number that you're comfortable with. But if you think about it, $25,000 today in 10 years with inflation, like $25,000 is going to be worth a whole lot less. So even in 20 years, you continue to fund this thing, it's going to be worth almost nothing. So that would be the two downsides. You have to commit to the number and be totally comfortable with it. And you got to have a long-term outlook to see that this thing, like, it takes time. It's like, it's just like the compound hockey stick. The first couple of years, you're putting all this money in, you're maybe not seeing much progress, but then if you use it right and you leverage it right, and like you get it, you truly get it, I think it makes a lot of sense. So
I like it. That's great, man. Thanks for the tutorial. I don't think we planned to go there, but at the same time, I think it was great to kind of like, my curiosity was piqued. I wanted to get a better sense of this.
Yeah. It's one of these things. I think I've been about a year exposed to it. And I think it's just like a couple of weeks ago, it actually clicked with me. Like it's because it's not as simple as just like, I put money in this thing and it grows. Yeah. And you could do that. You could just put money into it. You could not do the line of credit. You cannot like leverage it, but you're going to get a 4 or 5% return. And you still get death benefit. And it's still, you could use that as a bucket. If someone wanted to do like, I don't know, you're familiar with like the 3-fund portfolio?
No.
So it's like they call it the bogglehead. It's like people who follow Vanguard. It's a simple stock investing where you invest in 3 funds.
Oh, yeah. No, I'm very familiar. In fact, I'm sorry. I hear, so I talked to another group about wealth, and many of the group are like, I got $5,000. Like, what do I do? And listening to what they want to do, it's set it and forget it. So if you're talking about like drop a third into a total US index fund, drop a third into an international fund, drop a third into a bond fund, all Vanguard, like, and just move that around year to year. Is that what you're talking about?
Well, so the 3-fund portfolio is like, you say, I'm going to invest, instead of like picking what stocks and bonds you're going to invest in. The idea is like you invest in, a domestic total market fund, an international, and a bond fund, right? You set percentages based on your risk tolerance. So if you're like, more aggressive, you put maybe 20% in bonds, or whatever less. If you're more conservative, you do 30, right? That's like a simple way. Now, one of the ways someone could bridge the gap between, where they're at now, maybe 100% stocks and bonds to this thing, is that insurance policy is going to pay, let's say it's 4 to 5%. and it's secure. It's very secure, like a bond. So one way you could say is I'm going to invest zero in bonds, and whatever money I would allocate to bonds, I'm going to put towards this life insurance policy, which is going to earn double plus have death benefits and have all these other, I can leverage it. So that'd be one way someone could transition. They say, all right, I'm going to put whatever, $12,000 or $15,000 a year, which represents whatever 30% of my annual input into this thing. And instead of, so you just do domestic stocks, international stocks, and then the policy. And that would potentially bridge the gap of the security aspect of it. So
Interesting, man. That's a great tutorial on it. I appreciate you going down that rabbit hole with me. Apologies for taking you down it, but that was great. All right, let's pivot over and wrap up with some one sheet questions. So we've talked about the financial garden, the horizontal income space. So I'm good there. Let's move over to family. You mentioned you have the two kids, boy, girl. What are the 5 and 7 months? That's where they are right now.
Yep. So I have two beautiful girls. Annabella is 5 years old, and Emerson is 7 months old as of today.
Any more coming, or are you guys good?
I hope not. My wife hopes not to. So
okay, you're aligned on that at least. Gotcha. What does your wife do? Stay at home, or she?
Yeah, she stay at home. She works, teaching the kids, making them into awesome little children.
Have you ever done that for more than like a day? Just been the guy at home with your kids?
Yes, it's.
I don't know.
I give a lot of credit to my wife. It is
anybody, stay at home dads, stay at home moms, anybody that's ever done it, man. I know enough of myself to know that that's not me. So God bless her for doing it. That's incredible.
Yeah, she's a rock star.
Let's talk about health. So what's diet? What's exercise look like?
Yeah. So diet, I mean, in general, I eat pretty good. I mean, I try to stay away from junk food, fast food. I've always been pretty lean. On the exercise front, I'm working to actually just starting now in January with a personal trainer. I need like the accountability. Like I need someone to hold me accountable. Like I've got the Peloton, I've got the like Bowflex, but like I never get on it. I need somebody to kind of kick my ass and make me work out like you and your spin.
Dude, I'm telling you, like that. People say like, why do you get a Peloton? I'm like, because I won't do it. I won't use it. Like I need to go. And the other part too, like you talk about decision fatigue, like to go to the gym without a trainer. And I've never actually had a trainer. I've always done classes. I've always enjoyed group classes, like spinning. But to go to the gym without a trainer, like there's a lot of thought there. Like, okay, what am I going to work today? What's the right sets, the number of sets, number of reps per set, the right weight, like, my form, like there's a lot of thinking in that. So like what I love about spin is I go, this woman yells at me for 45 minutes. I don't have to think. She says something funny. I write it down and I get out of there. My exercise is done for the day.
Does she follow you on Facebook?
There's like 5 of them. And like, I think I'm up to 3 that follow me now. And they're great sports about it. They're great sports.
So I'm working on
like, I did say that. One lady, like, I did say that. I'm like, see, thank you for the validation. This isn't me being just a sick pervert in the back of a class, but yeah, go ahead. I'm sorry.
And I'm working on learning how to play golf. I've now 2 seasons now, played a couple times. So working there. And then I used to play tennis a bunch back in years ago. And so I've slowly working to kind of get that back up. So those are my goals. Some of my goals this year, picking up those activities.
Love it. What about contribution? Where do you like to contribute, whether it's time, money, energy, whatever it might be?
Yes. I mean, this is one I'm working on. I don't have anything specific. I think a lot of people struggle with finding something that they like are truly passionate about. And like, I could easily, we can give money to something, but I think it's more finding the direct correlation. I mean, I would love to find a group where I could help teach, younger kids about entrepreneurship and about money management and personal finance. And I think that'll be it's one of my goals this year is finding this group of probably young people who you can open up their minds and the how the world exists that they have yet to be exposed to. And, hopefully we can, if they're, some local kids here in Philadelphia, we can bring them into our organization. And, we're always looking for good people who want to learn. And, that'd be a
Tim Road conversation, like a One Life thing. Maybe that could be, I don't know.
Something like that, where there's people out there who they're just not exposed to it. And someone needs to just teach them and be that mentor. And from a business standpoint, I can help a lot. So.
How about adventure? I know COVID puts a wrench in a lot of people's plans, obviously, to get out there and do some fun things. But how about you? Anything that you have planned? Maybe it's like, once things clear up, or I don't know, anything that you have planned from an adventure standpoint?
Yeah, I mean, nothing's booked. I mean, we have our goals. I've never been to Europe, so we want to go to probably Italy, Spain. I love to check those out. Similarly, South America, I love, uh, South American food. I would love to go down to either to Cuba or Colombia or here in Dominica or whatever. So
Dominica, yeah, you can get a. I was told you can get a helicopter ride to oversee all of the green coffee facilities if
there
you
we
go down
go.
there. Adam will hook it up. I promise. He's a fellow Bills fan, so we can
There we
promise.
go.
I can promise helicopter rides on his behalf simply because he and I are both Bills fans. It's in the code. It's in the Bills Mafia.
There you go.
Talk to me a little bit about your pod. What are you guys talking about right now? What value, if any, do you get from that?
Yeah, so we're working on, I think, a little bit more structure. I think prior to this, it was kind of the first year, up for us as a group, and I think one of the challenges is just kind of I think it was more of a social hour than it was like a, hold each other accountable. Let's go over one sheets. Let's go over goals. So, all of us, want a higher level of accountability, and so, starting now in January, we're going to meet weekly instead of bi-weekly. We're going to set more rules around who is, attendance. I think, towards the end of the year, we had a bunch. I mean, I missed a few. Somebody else missed a few. It got very sporadic, and it was like, let's get more social than it was effective. And anyway, I think a couple guys are W-2. They want to get more into investments, holding them accountable for finding businesses, and hopefully once they find one, the actions they got to take. For me, I'm working on my podcast and working on this course or whatever it's going to be, that's going to try to be the system in a box. And so for me, I'm writing a lot and just trying to get my thoughts on paper. So my accountability for me is is content towards this book and this system. So anyway, that's the theme of the year. It's just holding each other accountable and just really trying to have as productive time as we can.
Let's wrap this with a question from the GoBundance card game. The one I just had was, I was going to ask it, but I felt like it was kind of obvious. It was, what was your nickname as a kid? I'm going to guess it was Beers.
That's right.
Okay. Yeah. So that was too obvious. If you were, it would be like asking a guy with the last name Smith, what's your nickname as a kid, or even today, Smitty. But let's do this. Describe a high point moment in your life.
Let's see. Well, there's a number. I mean, obviously, my both my kids being born was huge components of my life. Actually, my 7-month-old, we had her at home. My wife had her at home intentionally, and so because of COVID and everything, so that was a extremely interesting and actually a really good experience. So that was really cool. I don't know. Besides that, I'd say, I hired a coach in January of 2021, so this past year. I think that was like a big investment in myself, where, once again, this is another thing I learned from GoBundance. All these successful guys, you think they know it all, but like all of them, or a lot of them, hire coaches who are, other people who just, have that kind of personal relationship and can help hold them accountable, can introduce them, can give them ideas. And so I hired a coach, and, it was a big investment kind of really in myself. And from that, I launched the podcast, and I've kind of continued to grow and continued to learn, about fear and like, what are my limiting beliefs? And I've learned like how to identify a limiting belief and think to myself, like, all right, that's a limiting belief. Like I'm the one making that up. Like no one else is telling me this. And once you see it, like, and you can hear it in yourself, then you know how to overcome it. And I think, for me, it was kind of unlocking your mind that we're all capable of doing anything we want, and that the world is abundant, and that as much as we ask for and we commit to like getting, we can receive. And so for me, it's really learning all that stuff and now actually like putting it to use, and this idea that like we can have anything we want. Anybody can have anything they want if they take the right actions, they have clear goals, and they're accountable. So
Love it, man. That's amazing. That's amazing. Where can people learn more about you, the podcast, all of that stuff? Where do you want to direct folks?
Yeah, sure. A couple different ways. I mean, brianbeers.com with an I. We'll have links to the podcast, my email, Instagram, Twitter, all that stuff. Business with Beers is, on Apple Podcasts, Spotify, whatever. That would be the probably the best two ways. And then from those, it's got all the links. So
when is it, like, I was on the podcast early on, but is it evolving yet to where we use the name, but we also use that name to do that on in other words, can we you get drunker and drunker. Like you should have like a 10-question round with
Oh yeah.
a full beer for each round, and then just see where the last question goes.
There we go.
That's a listenable.
All
I
right.
mean, it's a great podcast now, but that would be like next level. You could even do like a one a month version of that. Just get drunk once a month with your guest and go
I
10.
like question 7. We're not even sure what the questions are. Or
Right,
we're
yeah.
losing
I got a
track.
question,
Yeah.
man. Do you love me? Like that kind of, like just get crazy after question 6 or 7. I'd be
I have not
curious.
done that, but I'll write that down as a recommendation.
From one host to another. That's my gift to you, my friend.
There you go.
Love it.
Fantastic.
Well, I appreciate you jumping on, man. I appreciate you as always. Hope to see you at an event in the future. And yeah, keep on doing what you're doing. I look forward to the course and everything else coming out too. So
Awesome. Cool. Well, thanks for having me.
my brother.